Thank you for joining me. My name is Nikki Young, and I'm a financial advisor with Northwest Financial Advisors, a wholly owned subsidiary of Northwest Federal Credit Union. Welcome to tonight's presentation of Getting the Most Out of Your TSP. Having worked with so many government employees over the years, we really have a unique and in-depth understanding of the Thrift Savings Plan, and we're really happy to provide you with this educational information. However, please understand that our firm does not administer or have any official affiliation with the plan. For assistance with assessing or managing your TSP, please visit your account at tsp.gov or see your benefits administrator. Now, I'm going to break this presentation up kind of into two parts. The first part of the presentation will cover TSP and retirement during service, and then the second half will address TSP and managing it after service. Before we begin, a few compliance items. I want to be clear that this presentation is general in nature and may not address every single TSP topic. We will have a brief Q&A at the end to provide you with an opportunity to ask questions. However, in consideration of all attendees, specific, unusual, or complex inquiries are going to be better suited for a personal consultation. Please also be advised that this presentation is being recorded for the purpose of sharing the content after the webinar, but all attendee questions and comments will be removed to protect your privacy. Please also note our required securities disclosure. All right, so for federal employees covered under the FERS system, you have a three-part retirement package that is made up of your eventual pension once you become eligible, Social Security, and then the TSP. And the TSP is your opportunity to save a portion of your income and invest it for retirement. And the sooner you begin contributing, the better off you're going to be, because accumulating enough funds that you're going to need not only to retire comfortably, but have the lifestyle you want in retirement, it can take a good amount of time. And it becomes more difficult the longer you wait. When you start contributing, it really has a significant impact on your earnings potential. If we take a look at this chart, which assumes an individual with a salary of $40,000, they're contributing 5%, they're getting their agency contributions of 5%, and they're getting a 6% average annual return. You can see the difference in account value with this individual having only 10 years to invest versus having 40 years to invest. It's over a $600,000 difference, and each decade, the portion of the balance that represents earnings gets larger and larger. And that's because investing, it's the long game. And so it's best to give yourself that time. Now, with that said, it's never too late to get started saving. One may just have to adjust your saving strategy in order to reach your goals. For example, let's say this person wants to have $1 million by age 65. If they start saving at 25, then they'll have to save about $250 per paycheck. Not bad. But if they wait until 45, then you'll have to save about 4 times that much at least, or $1,100 per paycheck to make up the difference, which could be more straining on our cash flow. So it's doable. It just may take a higher savings rate depending on what your target income is to make up that difference. Now, TSP does make it pretty easy. When you begin federal service, you're automatically enrolled in the TSP at 5%, which allows employees to capture the full TSP match of 5%. So right out of the gate, you're at 10% contribution rate. And I'm a big fan of automatic contributions and enrollment because then you don't see the money and you don't really have a chance to miss it. The tax treatment of Roth versus traditional. Within the TSP, you have the option to make 2 different types of contributions. You can make traditional contributions or Roth contributions, and I'll go over the differences between the two. With traditional TSP, the contributions are coming out pre-tax, which means you're not paying taxes on any of that money now, so less money is going to be taken out of your paycheck. But then in retirement, when you go to withdraw that money and start taking income, that money is going to be 100% taxable at that time. With the Roth TSP, the contributions are coming out after tax, which means you are paying money on that taxes now. You are paying taxes on that money now, so more money comes out of your paycheck. And then in retirement, as long as you meet the Roth rules, the money will be income tax free. And what are the Roth rules? So it has to be 5 years that have passed since the year you made your first contribution, and you have to be at least 59 years age of older, 59 and a half or older, permanently disabled or deceased. Now, keep in mind that TSP will keep your traditional and your Roth balances in separate buckets in your TSP account for the purposes of tracking contributions and transfers into your account. Now, with transfers, you are able to transfer in and out of both your traditional and your Roth bucket. For your traditional bucket, transfers in are allowed from other eligible employer plans or traditional IRAs, or you can transfer out the same eligible employer plans, traditional IRAs, and even Roth IRAs. But I'm going to go into that and how that works a little bit later because it's not as straightforward as that. With the Roth TSP, transfers are allowed in from Roth 401ks, Roth 403bs, and Roth 403bs and Roth 457bs. Transfers out are allowed to those same accounts and Roth IRAs as well. And if I didn't mention it, with the Roth TSP, you're paying your taxes up front, and then in retirement, as long as you meet the rules, that money will come out income tax free. Now, if you have both the traditional and Roth buckets within your account, there are certain transactions like loans and fund transfers and reallocations that will include a proportional amount of each balance. And so for an example of what that would look like, let's say your TSP is made up of 50% traditional and 50% Roth, and you want to take a $10,000 loan. $5,000 of that money will come from the traditional balance, and $5,000 of that money will come from the Roth balance. Now, if you want to take a withdrawal or a distribution from your account, you can choose to do the proportional method, or you can choose to have the money come out from your traditional balance only or your Roth balance only. And that is a new rule. It didn't used to be that way. You used to have to take it proportionally, but they've changed that. And I think it's a welcome change for a lot of people to where you can say, only take this contribution from my traditional balance or only take this distribution from my Roth balance. So with the Roth TSP, I do want to mention to not get confused with the Roth TSP with the Roth IRA, because there's a common misconception about income limits when it comes to Roth accounts. So hear me when I say that there is no income limit on Roth TSP contributions. So even if you're bringing home $1 million salary, you have the Roth option within your TSP, and you can fund it should you choose to do so. You can even split the contributions up. You can do some to the traditional, some to the Roth. And I know where the confusion comes from, because really the Roth TSP is only 10 years old. It started in 2012. And now a lot of people have these huge TSP balances that are all pre-tax, which in turn means a huge tax bill potentially in retirement, because you have your pension, that's taxable. You have your Social Security, that's taxable too. So consider if it makes sense for you to diversify some of your contributions in the Roth TSP and have some tax-free income in retirement as well. Contribution limits. The IRS places limits on the dollar amount of contributions you can make into employer retirement plans. That does include the TSP. They calculate it every year, so it often changes, increases annually. We're almost to 2023, and they just put these out, so I have the 2023 contribution limits up here. We have the elective deferral limit. That applies to you, how much you can put in from your income. And that limit for next year is $22,500. It is a combined total for the traditional and the Roth. So if you're putting that amount all into traditional, the $22,500, you don't have any room left to contribute to Roth. The next is the annual addition limit. Now, that is the limit that's imposed on the total amount of contributions made on behalf of an employee in any calendar year. That is going to include your elective deferral contributions, and then as well as your agency and matching contributions. But what it does not include is your catch-up contributions. And what a catch-up contribution is for individuals in the year that they turn 50, you can contribute an additional $7,500 next year, and every year after that, whatever that limit is, in addition to your elective deferral limit. So for next year, if you're maxing out the elective deferral and you're doing the catch-up contribution, you could be potentially putting in $30,000 in that year if you're over 50. So fund your plan as much as you can and what works within your cash flow. There's nothing wrong with maxing it out. I've never heard anyone say that they save too much for retirement. Sometimes it's quite the opposite. So just keep these limits in mind and know what you're eligible for. And if you are not maxing out yet, as you get more available cash within your cash flow, pay increases, whatever it may be, try to increase your contributions a little bit more so that way you're taking advantage of all the limits that you're afforded. A breakdown of the TSP funds. The approach of investing within TSP is broken down into 5 individual funds, G, F, C, S, and I will go over those specifically in the next slide. And then you have a selection of life cycle funds that you are able to choose from. The life cycle funds are percentages of all the other 5 funds. They are sub-advised by the mutual fund company BlackRock, and what happens is they get more conservative the closer you get to the year in the given fund. And the year in the given fund represents your projected retirement date. So for this example, we have the L2030 fund. So 2030, someone investing in that fund has a projected retirement year of 2030. And you'll see underneath the breakdown of all the 5 funds within this L2030 fund. And since we're, 8 years away from 2030, it has a pretty big allocation to the G fund, and that'll get higher as we move closer to that year. If you decide to use the life cycle fund, it's best practice to pick the fund that corresponds when you'll stop working completely, not just when you're going to retire from government, because if you're going to continue to work after that, then you probably won't be withdrawing money from your TSP, and then you may have more time for growth. So that's something to keep in mind as well. So what I have here is a list of the TSP funds and each of the objectives for your reference. The S fund, its objective is to match the performance of the Dow Jones Total Stock Market Index. So it is small cap, mid cap companies not included within the S&P 500. The F fund, it matches the performance of the Barclays Bond Index, and it just represents the U.S. bond market. The C fund is the S&P. It is a passively managed fund that remains invested according to its index investment strategy, regardless of stock market movements or general economic conditions. It is your S&P fund. Then we have the I fund, which is international, matches the performance of the MSCI EAFE. That's going to be Europe, Australia, Far East Index, a little international exposure there. And then lastly, we have the G fund, and that's going to be your stability fund. It says that the objective is to produce a rate of return that's higher than inflation, to avoid credit risk and market risk. I really like to think of it as a stability fund. If you put your money in there, you'll get a small amount of interest, but you won't lose any money. If you decide not to invest in the L funds and you would rather choose your own investment mix from these funds, it said that the allocation you choose is one of the most important factors affecting the growth of your account. I suggest taking into account the risk and return of each fund. They all come with their different levels of risk. There's market risk, which is the decline in the value of stocks or bonds. That's present in all the funds except for the G fund. Then there's inflation risk, and that's the risk that your investments won't grow enough to offset the effects of inflation. Now, that risk can be present in all 5 funds in the short term, but it can especially be present in the G fund over the long term. So just keep that in mind when you're selecting your investment mix. The amount of risk that you take should be within the comfort zone of your investment style, and it should allow you to maintain a long-term strategy. So that way you're not chasing the market returns during upswings or completely abandoning the strategy during downswings. One way to diversify the investments is not putting all of your eggs in one basket. Don't have 100% C fund. You may have a mix of all 5 funds in a way that's appropriate for you. Another consideration should be your investment time horizon. The more time you have, the more before you need to start taking the money, the more risk you may be able to take. And this is because losses in the short term are generally offset by long-term gains. So if you have 15 years or more until retirement, do you really need to move all your investments into the G fund because of what's happening in the markets today or this year? Probably not. So just periodically review your investment choices. Make sure that the mix you choose is appropriate for your situation. Annual returns and intraday declines. Market volatility is not a recent phenomenon, but I think it should be addressed because given the year that we've had thus far, I know it's hard not to feel anxious about that. We can have the best diversified, well-constructed long-term portfolio, but if we don't stick with it when things get uncomfortable, it's really hard to realize our full investing potential. Now, the reality is that markets are volatile and they fluctuate often. It's an unavoidable part of the investment process. And what this chart shows is that volatility each year is normal and routine. I would even take it a step further and say that it's necessary and a good opportunity. Each year, one can expect the market to experience a significant correction, which for the S&P 500 has averaged approximately 14% since 1980. Even during positive calendar years, we should expect the market to experience a correction. And according to this data, from 1980 to 2021, 29 out of 39 years, that's been the case. If we look at 2020, we ended the year with a 16% gain. But we had a pandemic that year, and we saw a 34% decline. So what I would recommend is get your portfolio evaluated. Make sure you're invested in the best way possible for your objectives. And if you have that, doing absolutely nothing during periods of volatility can be the most impactful action that you take. The impact of being out of the market. When you make the decision to cash out, move everything to the G fund, or when returns are low and volatility is high, it has a costly impact to your retirement plan because once you do sell out of your investments, you have to make another decision about when should you get back into the market. And the thing that gets a lot of investors is once you're out, it's hard to convince yourself to get back in, especially in the near term. What ends up happening is investors wait until the market is back at its highest to jump back in. And in addition to that, selling out of the market after the worst days is likely to result in missing the best days that follow, which has an effect in terms of your portfolio balance and the return. This chart here has a hypothetical growth of $10,000 invested in the S&P from 1980 to 2021, $10,000. If you were invested all days, you end up with a little over $1 million. And you can see as you start missing more and more of the best trading days, how your portfolio balance and the returns dwindle down. And sometimes this creates a narrative that investing doesn't work or it's not worth it, which is not accurate. Plan to stay invested. Trying to time the market is extremely difficult to do consistently, if at all. But market lows make us feel a little uneasy, and that's when It's beneficial to have a trusted advisor who can help put a clear perspective on things and ensure you have a strategy, not to avoid volatility, because if you're going to invest, it's unavoidable, but to manage volatility, which can result in a better retirement outcome. And I want to talk a little bit about retirement planning because that is what the TSP is for. That is what we're saving for. And retirement planning is one of the most, if not the most, important part of our overall financial plan. So it's helpful to define what our retirement looks like so we have a clear direction to head in. Defining retirement answers questions like, when do I want to retire? As early as possible or never? Next is, will you fully retire or work part-time? It's very common that individuals will fully retire from their federal career and then decide to, go back to work in the private sector full-time, work part-time, or even start a business. Now, those first two questions help determine our timeline, which is how long do we have to put this plan in motion? But the last question, how will your time be spent? It's really interesting because retirement offers the gift of time to do the things that matter most to you. So I would start thinking about what that is, what's most meaningful, because if you've been working for decades and that routine stops, you could find yourself spending time and spending money on things that don't really leave you satisfied. So it's best to have some idea of what's going to be happening after you transition. What are the associated expenses, which will in turn help us plan better. Now, we do need sources of income to fund our final retirement. That's going to include your TSP, pensions, IRAs, Social Security. It's also recommended to be realistic about longevity and how long you're going to need this money to last you. So that's going to wrap up the first half of the presentation. I would now like to transition to after you leave federal service and the options for your TSP account. So part two is going to cover those options in general. TSP provides so many benefits both during service and after service. During service, you have your tax benefits, low expenses, your life cycle funds, your agency contributions. But then after you leave service, your retirement funds are portable, meaning you can leave them within the TSP as long as you have more than $200 in your account. But if you choose to, you can also move those funds into an IRA. There are a variety of withdrawal options available, and it's best that you understand the rules that govern withdrawals and the different implications of the withdrawal options, whether you're separating from federal service to embark on a new career opportunity or whether immediate retirement is your objective. Before you exercise any of the following options, it's good to know how the decision is going to impact your retirement needs. So if you remain in the TSP and you would like to start taking income from your account, there are three basic methods of withdrawal. The first is going to be installment payments. So you can take them on a monthly basis, quarterly basis, an annual basis. They can be a fixed dollar amount, which is you telling TSP, hey, send me $1,000. It does need to be at minimum $1,000 or more. Send me $1,000 every month. And they will do that. Or they can calculate the monthly amount based on your life expectancy. So this is not you telling them how much money you want. This is them telling you how much money you can take, let's say on a monthly basis, based on your life expectancy so you don't run out of money. And these installment payments, they can be changed at any time. They can be stopped, started. So there really is flexibility with that. You can do single withdrawals. And that allows you to make a one-time withdrawal, again, of at least $1,000. There is no limit on the number of single withdrawals you can do, but they won't process more than one in any 30-day period. And that's simply because of processing times. What we have seen is in reality, the 30 days can be extended just because it's a paperwork process within the TSP, but there have been some positive changes towards electronic processing, which hopefully is speeding things up. But for now, it's once per 30 days. And then lastly, annuity purchases. You can use all or a part of your TSP account to purchase a life annuity through MetLife, which is TSP's annuity vendor. With annuities, when you do it, it's final. You will not have access to that portion of your TSP funds to use, and it can't be changed once it's processed. So just really consider whether or not that's going to be best for your needs. And just to drive the point home, if you select that option, it is permanent. So select the annuity that you feel best suits your needs, because you can't cancel it. You can't change the annuity option. You cannot change the joint annuitant if you decide to go that route, which has its own implications in itself. And I'll just give my own personal opinion here. If you're a federal employee and you're retiring, you already have two sources of fixed income. You have your pension and you have your Social Security. So if you have both of those, I just don't see the need for another one in the form of a TSP annuity. There's fixed income, it is important, but control and flexibility is important as well. And I don't know if it's best to give up all the potential growth of your TSP funds to an insurance company. Just my take. Required minimum distributions, RMDs. So if you have separated from service, the IRS requires you to receive a certain portion of your TSP balance annually, beginning the year in which you turn 72. And that's so you can start paying taxes on that money. And the portion that they require you to take out is based on your life expectancy and the balance of your account at the end of the year. And so they'll calculate that annual payment, which is known as your required minimum distribution or your RMD. If you remain in the TSP and you do not take your RMD, but in the year you turn 72, TSP will send it to you by April 1st of the following year. If you choose a withdrawal option with your account, TSP will look to determine if you need a RMD, and they will notify you and then distribute it to you as needed or as you request. Now, the minimum distribution requirement only applies to participants who have separated from federal service. It does not apply to active employees, regardless of your age. So if you're 74 and you're still working, you do not have to take an RMD from your TSP. Now, if you have any outside IRAs, then you will, but in terms of the TSP, if you're still working, regardless of your age, there's no RMD due. You'll just have to address that and may have a larger RMD once you actually do stop working. Understanding the TSP limitations, I think TSP is a great place for accumulating retirement savings. It's very low cost. It has some nice broad investment choices, but there are some limitations that I think it's worth being aware of. One of the things, and I've kind of mentioned it before, is the processing times. You can only change your distribution or request a single withdrawal once in a month, every 30 days. So if you have a tight timeline and you need more money and you just took a withdrawal, you're going to have to wait. And on the next slide, I'll address another processing time situation that really bugs me as well. But number two, there's no Roth conversion within the TSP. Since the Roth TSP is only 10 years old, many federal employees have large traditional TSP balances, which could equal large tax bills in retirement. There's a popular strategy called a Roth conversion. And what that is you take the funds from your traditional portion and then you convert them to a Roth IRA. When you do this, you pay the taxes on the money at your current rate in that year, but then from there moving on, the money grows on the tax-free basis as long as you meet those Roth rules. The TSP does not allow for Roth conversions within your account. If your end goal is to take all or a portion of your traditional TSP and move it into the Roth, what you're going to need to do is first transfer the money into a traditional IRA outside of the TSP. Then you can convert to a Roth account. You may already have a Roth IRA account open, or you may need to open one up. You can do this if you are separated from service or if you have reached age 59 and a half. Roth conversions, are, they may be good for some, may not make sense for others. You want to conduct a careful analysis, a tax analysis, to determine what your tax bracket is and the most advantageous amount to convert to a Roth. Under the Tax Cuts and Jobs Act, it's important because there's no undo button on a Roth conversion. Once you convert those funds, there's no going back. The Roth TSP is subject to RMD rules. One of the most overlooked advantages to the Roth IRA is that it is the only type of retirement account that an individual does not have to take RMDs once they turn 72. And that's because Roth dollars are tax-free, so there's really nothing for the IRS to collect. But if you remain within the TSP, the entire balance, your traditional balance and your Roth balance, will be used to calculate your RMD. And then that's where it gets proportional, and some of it will be taxable, some of it will not be, but they're still using the entire balance to calculate what that payment would be. So that's another limitation there. And then lastly, proportional fund withdrawals. This applies to the investment funds, not the traditional and Roth balances. You can still request $1,000 specifically from traditional or $1,000 specifically from Roth, but what you cannot request is $1,000 specifically from the G fund. Any money that you take from your account will be proportionally taken from each TSP fund that you have. So if you're invested in multiple TSP funds, all of them will be affected by your distribution. And why this may not be favorable is because let's say you have a larger portion in the C fund, you may not want to take money from the C fund that's down 17% this year. You may want to give it a little time to recover and come back, but you don't have that choice. For this reason and many others, a lot of federal employees consider moving some or all of their funds outside of the TSP into an IRA. So there's a few items to work through when we're making the decision to stay with TSP or to move elsewhere. As I've discussed throughout the presentation, choosing the correct risk tolerance, and it's a big step to ensuring our investment results. We want to make sure that we're taking enough risk to meet our objectives, but we don't want to be too conservative or even too risky. And being able to talk to someone about your risk tolerance and what makes the most sense can be very helpful. Fees. That TSP has the lowest fees, and fees are important, but they're not everything. The TSP cannot provide investment advice on a financial plan, an estate plan, and they're not a fiduciary. So you can call them and you can ask the question and they will give you the best answer that they have. But that answer may not be based on what's best for your objectives, taking into account all the financial factors that are unique to you. If you decide to move to an IRA, you can manage it yourself or you can work with an advisor. Just make sure you understand the fees associated so you can weigh the costs and the benefits there. Consider the implications of TSP and your estate plan, Secure Act. The recent passage of the Secure Act has impacted estate planning in a real way. When we pass and we leave our TSP assets to a spouse, they can open a TSP spousal account and transfer it into that. However, I have literally seen the paper that tells them that it's going to take anywhere from 12 to 18 weeks to get this done, to process it. When assets move to a non-spouse, TSP doesn't even allow them to open an account. They mail the account paperwork to your beneficiary, who has 90 days to complete it and get it back to the TSP. If they don't get it back in time, TSP will just mail them a payment. And if your balance is all pre-tax, they will have to absorb the tax consequences of that. The Secure Act also states that any non-spouse inheriting an IRA has 10 years to take out all of the funds starting the year after the year of death. Now, there are a few exceptions to that, but that's for most non-spousal beneficiaries, that's the rule. They have 10 years, and that's the case for both traditional balances and Roth balances. And it all brings me back to those large traditional balances, which have to be emptied and the taxes paid in 10 years, which is really making Roth conversions very popular, but you can't do that within the TSP. And, I'll just say that all of these things with estate planning and beneficiaries when we pass, all of this stuff has to be addressed and done when our spouses and our loved ones could be in emotionally compromised states. So it could be helpful to have a third party to help your beneficiaries walk through these steps, review the paperwork, because these things are really important, and we definitely, don't want to make any mistakes and do it in a right way. Lastly, you can go at it alone, but you'd probably be better off with a good advisor. We've covered a lot of material about planning and the impacts of our decision for TSP. Vanguard, which is a really popular company with do-it-yourself investors, they have a publication, and it's Bringing Value Through Advice. And it's where they describe how financial advisors bring value to their clients. And we've included a copy of this in the handout section in your control panel. So you can download it from there. If you can't get to it, we'd be happy to email you a copy. Just let us know. Before we wrap up, I do want to mention the Voluntary Investment Plan, or the VIP as it's called. It is an agency-only supplemental retirement plan, and really a neat opportunity to add more retirement savings. So employees can contribute 5 to 10% of the biweekly base salary. 10% max, minimum amount is $5. Only employee contributions are allowed, no employer contributions. Retirees cannot make contributions. Once you retire, you can keep your account open. There's no requirement to close it. The only thing is that if you're 72 or older, you would need to start taking an RMD from that account. Now, I don't work for VIP or have access to their systems. They're a little ominous, but you can call or visit their website for more information. There are 4 investment choices within the VIP: growth, income, aggressive, and index. What I really like about the VIP is that it is great as a Roth alternative. When you make contributions into the VIP, your contributions are after tax. And so the VIP has a ruling by the IRS that allows your contributions to be rolled into a Roth IRA at retirement. So here's an example of that. This individual makes career contributions of $20,000 into the VIP. Those are after tax. Depending on how they invest it, they get growth of $10,000. What we can do is, and what we do is, we take the $20,000 in after-tax contributions and we put it into a Roth IRA, and then we take the $10,000 of growth and roll it into a traditional IRA. And then there's no taxes due, and now you have a Roth. So there's some talk about doing away with this rule. So if you have VIP and you're retired, it's something to really consider. The last thing I'll say about that is VIP also allows front load contributions when you get closer to retirement. So that's why I say if you have VIP available to you, just put the minimum in there, and then you can figure out, how to fund it later, because they allow front load contributions. And what I mean by that is at retirement, the VIP will run a calculation where you can make a lump sum contribution into the plan, and that would essentially allow you to fund a Roth through a lump sum payment. So if you have it available, just put the $5 or whatever the minimum amount into it just to get it going. There are many resources, and about the TSP, I encourage you to take advantage of all of them available to you, including meeting with us if you would like some extra guidance. As I mentioned before, we don't administer the TSP. However, we have worked with countless government employees who are building or have built up their retirement wealth through the TSP and the VIP as well. So that's going to conclude tonight's presentation. If you don't mind, we will have a survey. We'd love to get your feedback. Any feedback is greatly appreciated. It only helps us make these presentations better. Also, you will have the opportunity to request a complimentary consultation with either myself or my fellow advisors. We are eligible to meet in the Herndon, Maine office virtually or at any of Northwest Federal Credit Union's branches. We do service the branches by location. Myself, I service all of our Loudoun branches, so that's going to include one Loudoun, Leesburg, and the Middleburg branches, and then our Herndon office as well.